All right, people. Oh, okay. I think I'm live now, right? Am I live, Anton? I think I am. All right. Hey, welcome, people. It's your man, Brandon, here from Visionary Lending. I hope that you are well. I hope and pray that your families are doing well during this time. So, what I want to talk about right now is this. I've had multiple conversations with different buyers, different real estate agents, and people in the real estate profession over the past several weeks about in the DMV. I can't really speak about anywhere else, specifically specifically in the DMV. What is going on? Okay, it's getting crazy out there. In fact, it's been crazy out there. So what do I mean by that? What's going on is that every time you go online to look to see if a home is available, right, or what homes are available, you're going to see one of two words: contingent or pending. Okay, contingent or pending. What do those words mean? Those words basically mean not available. Okay, under contract. The buying and selling market is getting out of hand, to say the least. I'm gonna dive right in and get right to it. And I highly encourage you, please send me your comments or questions or challenges on some of the things that I'm going to share, because I love to have the interaction and the dialogue. I do not claim to know everything, for sure, but I want to be able to share my professional opinion and my observations 2021 year to date. Specifically in the DMV, what is going on is this. Number one, sellers, to their credit, are getting not only top dollar, but higher than top dollar on average when they are selling their homes. This is because of a feeding frenzy of sorts with regards to buyers. Many buyers, I'm not going to say all buyers, but a large portion of them are not only offering, a little bit above the list price, they're offering way above the list price. So for example, let's go right up the street to Loudoun County. Let's say in Loudoun County, your average single family property is selling, let's say, for about $700,000. Okay. Now, when that house goes on the market for $700,000, the list price is $700,000. There's a reason the list price is $700,000. That's because the listing agent, the realtor who represents the sellers, has done their due diligence and says, okay, the homes within a certain radius that have a certain number of bedrooms and bathrooms and square footage that are very similar to this property have been selling for this amount. So this is a fair amount to ask for this property. But what is going on? You will see buyers coming in offering 730, 740, 760 for that particular property. Okay. It could be Loudoun County. Honestly, it could be Prince William County. It could be Arlington. It could be Fairfax County, for all that matters. It could be Montgomery County, Maryland, truth be told, and especially in certain places for Washington, D.C. Okay. Buyers are offering far more than the market value of the property. Okay. So you have a market value. I was having a conversation, and shout out to my man Tony Roque, realtor out there. He and I were having this discussion yesterday. You have the market value, right, which is the appraised value of the real estate, versus what buyers are assigning to property, which is the intrinsic value. Well, you know what? I know what the market value may be, 700,000, but I'm willing to dig into my piggy bank, my 401k, my TSP. I'm willing to sell stock, my money market, and I'm willing to do whatever it takes to get that house. I'm willing to come in and pay an additional 50, 60, 70, 80, 90,000 above what the house is actually worth in terms of market terms. All right. So that's good for the seller. It's good for the seller's agent because they all get paid more. Okay. Let's be honest about it. But what it's not good for, okay, is it artificially drives up the market. Artificially. Okay. And a lot of people talk about, well, back in 2008, this and the other. Yeah, that stuff is true, but this is a very different market. It's a very different mortgage market. It's a different economy. So you really can't compare those apples to apples. But what you can compare is the fact that people are willingly and voluntarily putting themselves what's called underwater. They're giving themselves what's called negative equity. Because if the house value in terms of the appraisal value is this, but you owe this in terms of how much you've paid for it, well, the difference there is negative equity because you actually have paid more and you owe more than the property is actually worth. But for some strange reason, people don't seem to care. They are ignoring logic, financial logic, and they are just more going for the fact that they got to have this property. And it really doesn't make any sense. Okay. And from the discussion that I had also yesterday with Tony, it's so true. And I had another discussion with a client that I'm currently working with, is that there seems to be a lack of patience and a lack of trust in the process. As if, these are the only homes, single family homes, townhomes that are ever going to be available. That you have to have this house and you have to have this house right now. And you're willing to put yourself in either financial peril or spend that money on something else, that could be better spent somewhere else. You're willing to put it into this property with the hopes that at some point, okay, you're going to end up catching up in terms of the equity that the house will appreciate in value. I can promise you this. Once the housing market stabilizes, because it will not continue like this forever, because that is a similarity that we have with what occurred 13, 14 years ago. People just kept thinking, okay, my home's going to keep going up in value. And they were just kind of hoping on that. You cannot do that. That's unwise. If and when the home market stabilizes, which means that the demand will decrease and diminish to meet where the inventory is, or the inventory will come up and meet it, or you'll have a convergence of the two, okay? Then you have more reasonability in the market. And when it's more reasonable, the typical appreciation per year, at least within this area, is probably in that 3 to 4% range in terms of homes appreciating. So if you are one of those individuals, or if you are considering putting down an extra 10 or even 15% on top of what the property value is, when the market stabilizes, realize you're going to have to wait 3, 4, 5 years just to reach par, just to get yourself back even in terms of the amount of equity that you have in the home. And so you're not going to put yourself in the wisest financial position. Am I saying that you shouldn't do that? Listen, you are grown. These are grown people who have their own money that has been earned or saved in some form of fashion. So you can use your money the way that you want. Okay. But what I am saying is that the long-term effect on the housing market is going to be negative for sure, because it gives a distorted view of what the actual market value is of these homes. And so as a result, you may, in let's say next 3 to 5 years, you may have increased short sales. You may have increased foreclosures, for sure. Because again, the equity position that people are going to have in their properties is going to be negative, and it's not going to put them in a good spot. I can guarantee you that. Now, here's my prediction. I'm not really like Nostradamus, right? But my thought is this: you have hundreds of thousands, if not millions, of people that are currently renters but are entering the purchase market. And over time, they'll get discouraged because they have multiple offers that are not being accepted. So at some point, they're going to drop out of the market and say, you know what? We're just going to renew our lease for the next 6 to 12 months or whatever it is, and they're going to drop out of the market. So now you're going to have a decrease in demand, right? Which in economic terms, what that does, it fights head to head against the scarcity, right? It's a scarcity. I'm not scared of you. And basically scarcity means, the amount of supply of a particular product or service. And so just because the supply or the inventory is low, right? Well, now the demand is going to decrease at some point. I can definitely promise you that. So sellers will no longer have the leverage that they have currently. Okay. Now I've listened to different podcasts, And I was listening to one that's actually very popular with a realtor out in California. He had a couple of agents on it, like, yeah, sellers, they're going to list it for here, but they're going to sell it for well above list price. But they didn't even talk about what the implications of that are on the market because they don't care. And that's my opinion. You cannot have that type of transactional mindset. All they care about is, okay, my commission, my commission, my commission, my commission. Okay. Now, yes, I do not run a non-for-profit and I do work on commission myself, but at the same time, I think it's important to see what the overall effect on the real estate market is, and to have those discussions with buyers and sellers on what the actual effect is when someone far overpays. Okay. Sellers these days have so much leverage that they're essentially demanding that people are waiving what's called an appraisal contingency, which is absolute nonsense. Absolute total nonsense. Waiving inspections, you can kind of go here or there, or even possibly asking buyers to pay for some of like their own fees, or asking buyers to pay for the listing agent's commission, which is total nonsense. There's a taking advantage that's taking place. And now we are in a capitalist economy, and I am a capitalist. So, but I just disagree with it. So I'm just sharing. I don't think it's right, and it's not healthy. But as long as buyers completely understand what they are doing and what the implications and the ramifications are of such, as long as they understand that, then you really can't stop people from making those types of decisions. But my encouragement is definitely for people to be patient, okay, and to trust and to have faith that the property that you belong in, okay, is going to come along, that the market will eventually adjust and stabilize, and you'll get where you need to be. Now, the other thing that I really wanted to talk about is this. I've had some conversations with various realtors. Shout out to Giovanna Holmes Group over down here in the Woodbridge area, and shout out to Steph Sells, the DMV at EXP. Shout out to my man Rick Wanzer over at Pearson Smith, and shout out to Mona Paquette. But here's the deal, okay? A lot of sellers, I don't have the statistics, but I'm gonna get the statistics. I'm gonna get the metrics, right? Probably at least 80 to 90% of sellers out here are only taking seriously what's called conventional offers. Okay, so we're gonna talk about that for a few minutes. All right. In my opinion, I think that sellers are being misguided. Let me repeat that. In my opinion, I believe that sellers are being misguided by their realtors into thinking that conventional loans are the best loans and the only way to go. And that is because of a lack of understanding as far as these realtors are concerned. So let me clear that up for you, please. Okay. If you have someone who is selling their home for $500,000, right? And let's say that's the highest and best offer, okay? It does not matter the type of financing that the buyer is coming to the table with, because the money's green, no matter if it says conventional, which is essentially Fannie Mae or Freddie Mac, essentially, or whether it's FHA, the Federal Housing Administration, or whether it's VA or the Veterans Administration, the seller is going to still net the same amount of money, and they should still be closing within the same amount of time as set on the contract. But for some reason, sellers are being told that conventional loans have stronger borrowers, so there's less risk, right? So you shouldn't really consider the FHA buyer. You should really consider the conventional buyer, which is completely untrue. So let me debunk that myth. For example, you may have had a person that has let's say you have two different buyers that are both offering $500,000 on the exact same property, okay? Exact same property. They both have 720 credit scores. Their debt to income ratios are the exact same. So what's the difference? Well, one has a Fannie Mae loan and one has an FHA loan. Okay. Well, the reason why the other person may have an FHA loan might be because of some personal or financial event 3 years ago. They may have happened to have a short sale or a foreclosure or a bankruptcy that they've already distanced themselves from, but their credit score is still 720 and their credit landscape still looks great. Okay. A conventional loan has a longer distance and period of time in between that type of a housing event or that type of credit event. Okay. But FHA doesn't. So it's a little bit more lenient, but you still have equally strong borrowers. The listing agent doesn't know that. The listing agent doesn't know that at all. They just say, oh, let me just choose this conventional borrower. Like, you should consider this person, even though both offers are equally as strong, or maybe the FHA offer might be stronger, but sellers are being misguided. They're being miseducated because of the short-sighted thinking and a lot of the selfish thinking of a lot of these realtors out there, because they want to go down the path of least resistance, where in their mind, at least, it's the path of least resistance. Or they may even justify, will say, well, you know what, if you do an FHA or a VA loan, you might not get the value on your home, which is completely untrue. So check out our YouTube channel, because I did an entire video, on different appraisals, conventional, versus VA appraisals and FHA appraisals. And I break that down for you. And I break down the myth. Okay. When you have an appraiser that goes out to a property, that appraiser is going to look at what's called comps. Comps are comparables. What are the homes within a certain radius, like I talked about earlier, that have sold? It has nothing to do with the type of financing that the buyer's getting. It has everything to do with the actual market value of that property. Okay, now, in all fairness, the FHA, the Federal Housing Administration, does mandate that certain safety items are, taken care of in a house. Like, you don't want to have broken glass, you don't want to have rust, you don't want to have railings that are missing, things of that nature. But I mean, that should really pass the common sense test, to be very honest with you, where conventional loans, conventional appraisals may not require that as much. But you would think that a seller would not want to sell their house with like railings missing so people can fall off the steps, right? Or broken windows and this, that, and the other. You would think that they would have enough consideration in selling the home where people are going to live, to fix windows and to do those minor safety related items. I mean, you would think. I mean, put your comments up, because I'm really curious to see what your thoughts are. But again, it's a misnomer. It's a myth. It's a misconception. It's a miseducation. Okay. That's because sellers, they're going to rely on the guidance and advice of their listing agents, right? Say, well, you should consider this over this, even though one offer is numerically stronger and better for them, they're going to still point them toward conventional, because they don't have the proper education and perspective as a lender would. And as a result, there are many perfectly willing and able and qualified buyers right now who are putting in offer after offer after offer after offer, highest and best, and they're not having them considered. And it's not right. It's not right. It is wrong. It is unfair. And I'm here to tell you that it's completely unfair. Is there anything that I can do about it? Of course not. No, but I can get out here and I can share with you the facts. Okay. That really perfectly good buyers are being discriminated against because of the type of financing that they're receiving. Okay, let me repeat that. Perfectly good qualified buyers are being discriminated against because of the type of financing that they're receiving. Not because their offer's lower, not because they're saying, well, I can only close in 60 days. No, all of that stuff is equal playing field. It's because of the type of financing that they're receiving, right? And you never know. You might go head to head, conventional and FHA. With FHA, someone's putting down 3.5%. That is the FHA minimum. Someone who's putting down 3% is the conventional minimum. Depending upon what their credit scores are, the FHA interest rate could definitely be at least a half a point lower. And if a person's putting down just 3% conventional, their private mortgage insurance might be higher. So doing an FHA loan might actually be more financially beneficial for the buyer. But guess what? The listing agent's going to look at two different offers and say, well, let's just take this conventional one, because the conception in my mind is that it's going to be better for everybody involved. And that is simply wrong. And you're discriminating against someone who got financing that's actually better for them. And numerically, the offer is the exact same for your seller. So are you really doing the best job for your seller? I'm asking the question, are you really doing the best job for your seller, or are you looking out for yourself because of your lack of understanding? Okay. I'm not trying to blow anybody up. I'm not trying to do anything like that, but I'm just trying to state the facts that are out there. As I've mentioned many times in my videos and my podcast here at Visionary Lending, we are advocates. We are advocates. We are using our God-given skills and abilities and talents to be able to advocate and represent for people and to be able to educate and tell the truth. That's all we're trying to do, is make sure that people are fully educated, especially in the area of real estate where you're going to end up, making a purchase of hundreds of thousands of dollars. You want to make sure that you have somebody that's actually looking out for your best interest as far as that's concerned. And that's what we do to the best of our ability at Visionary Lending. Do we know everything? No. Do we constantly learn? Do we constantly change and evolve and grow? Absolutely yes. Do we work to be humble? Absolutely yes. Do we work to be empathetic so that we can connect with our clients and connect with their needs and meet them where they're at? Not demand that they meet us where we're at, but we meet them where they're at. We take that extra step. We go that extra mile. That's what we do here at Visionary Lending. That's what your loan officer, no matter where you're getting your lending from, your loan officer, as an advocate, as they should be meeting you where you're at to help you get in best position to purchase a home. Because you're going to be the one that has to write that check or have that auto draft come out every month. You're going to be the one that's establishing memories with your family for years and years and years to come, right? In that property. So you want to make sure that you have gotten the best deal, the best interest rate, have been fully educated so that you do not have buyer's remorse at the end of the day. And when I was talking to Tony yesterday, he really feels that what's going to happen is that a lot of people are going to have buyer's remorse. And so shout out, because we will be doing a podcast specifically talking about those things. And you can hear it, from him as well. As a realtor, he really feels that going down the road that people are going to look back and realize some of the mistakes that they've made by overpaying, grossly overpaying. So they're going to end up blaming their agents, And I kind of agree with that, but I also kind of disagree with that because, again, I think people are getting into this herd mentality of I gotta have, right? And I think part of it is very cultural with what's been going on in our country because of two words: immediate gratification, right? Everyone needs that immediate gratification. Gimme, I need to have it right now. I've got to do whatever I've got to do to have it. Okay. And we're really taking steps back from the patience, right? And being more pragmatic and being more wise and not being so emotional when it comes to the purchases. So look, I'm just going to end off, as far as that's concerned. I know this is a bit of a rant, but I wanted to give you some facts. I wanted to give you some real information about the differences in financing that's going on out there. Am I saying that sellers should accept offers less, than their list price? I'm absolutely not saying that. I haven't said that over the past several minutes. What I'm saying is that if someone comes to the table with the highest and best offer, because that's the literal language, right? And numerically, the deal is the best for the seller, and you're going to be closing within a certain period of time. All right. And maybe even the buyer is going to, give the free rent back, and different things like that. That's all well and good. And those things should be negotiated. So let's be very clear. But in no way, form, shape, or fashion, whatever, should sellers be inclined to accept a conventional offer over an FHA or VA offer simply because they're being told to do so. Okay? That is wrong. And as a result, you are keeping a lot of very well qualified and well deserving people out of the market. And that is a form of discrimination. And no one can tell me that it's not. Okay? When you have the same offers head to head. So if there's anything else that you would like for us to discuss, address head to head, debunk, I'm more than happy to do so. If there's any new information out there, I would be more than happy to do so. When there are new articles, new things that I learn, I'm definitely going to get online and be able to share that, Because what's the point of having knowledge if you can't share it with other people so that we can all move forward and we can all do this together? So I just wanted to thank you guys for this few minutes that I've been able to share with you, talking about what's going on here. Do I have any like solutions? Honestly, I don't know if I necessarily have any solutions, as far as this is concerned. But if you're looking to get into the purchase market, I do not want you to be discouraged, but I do want you to be fully aware and have your eyes open and be educated. And again, we will make sure that you're fully prepared in terms of understanding interest rates, budgets, monthly payments, how the loans work, how the process works, making sure you tighten up your credit, whatever you need to do so that you're not in the dark, you're not lost. Oh, we've got your back for sure here at Visionary Lending. So make no mistake about that. But when something's on my heart as a professional and as an advocate, I'm not going to sit back and just not say anything about it. So thank you all for your time and attention. I'm very grateful. God bless. Please continue to stay safe out there. Thank you for all the comments that have been coming through. I'm very grateful for that. All right. And I look forward to doing the next Facebook Live. We'll be doing a podcast next week, talking about a variety of different issues, continuing to double down on the same thing. Okay. Continuing to double down and talk about the same thing because we care. So see you all again and take care.